So, you want to learn Bookkeeping, by Dave Marshall. http://www.dwmbeancounter.com. Financial statements. The objective of this lesson is not so much a how to do it, but to inform, introduce, and make you aware of the basic financial statements. Let's start this lesson by reviewing a few definitions. Financial statements are summary accounting reports prepared periodically to inform the owner, creditors, and other interested parties as to the financial condition and operating results of the business. The four basic financial statements or reports are: balance sheet, the financial statement which shows the amount and nature of business's assets, liabilities, and owner's equity as of a specific point in time. It is also known as a statement of financial position or a statement of financial condition. Income statement, the financial statement that summarizes revenues and expenses for a specific period of time, usually a month or year. This statement is also called a profit and loss statement or an operating statement. Capital statement, the financial report that summarizes all the changes in owner's equity that occurred during a specific period. Cash flow statement, the financial statement that reports the sources and uses of cash for a specific period of time, normally a year. Order of preparation. Because some of the statements use information from other statements, the statements are prepared in the following order: 1. Income statement. 2. Capital statement. Uses information from the income statement. 3. Balance sheet. Use information from the capital statement. 4. Cash flow statement. Use information from the balance sheet. Trial balance worksheet. A trial balance worksheet that we discussed earlier is prepared from the general ledger. The balances are taken from the general ledger and listed in this trial balance worksheet in the order of the accounting equation. Trial balance. Asset balances are listed first, followed by liabilities, and then owner's equity (ma capital), and finally her kids' revenues and expenses. Trial balance. Once you have a trial balance, it's simply a matter of transferring the amounts from the trial balance to use to prepare the balance sheet, income statement, and capital financial statements. Add in the prior year's balance sheet and you have the information needed for preparing the cash flow statement. It should be apparent that by having the information from the general ledger and the trial balance, one can readily prepare the balance sheet, income statement, and capital financial statements. The trial balance worksheet normally contains additional columns for adjusting and closing entries. Briefly, closing entries close the balances in the general ledger's individual revenue, expense, and drawing accounts to the owner's capital account at the end of a period, usually year-end, which results in the same general ledger capital account ending balance as contained in the capital statement. This ending capital balance becomes the new beginning capital balance for the new year. Closing entries. All the revenues, expense, and drawing account balances are reset to zero so that their balances will only represent transaction amounts, increases and decreases to owner's equity, in the new year. Income statement. The income statement is a formal financial statement that summarizes a company's operations, revenues and expenses for a specific period of time, usually a month or year. A fiscal year is the period used for calculating annual, yearly income statements. While a large number of businesses use the calendar year, January to December, as their fiscal year, a business can elect to use any other 12-month period such as June to May their fiscal year. The categories and formats of the income statement follow the rules known as Generally Accepted Accounting Principles (GAAP) and contain specific revenue and expense categories. The following types of accounts are used to prepare the income statement. Revenue, also called income. Formal definition: the gross increase in owner's equity resulting from the operations and other activities of the business. Informal definition: amounts a business earns by selling services and products. Amounts billed to customers for services and/or products. Expense, also called cost. Formal definition: decrease in owner's equity resulting from the cost of goods, fixed assets, and services and supplies consumed in the operations of a business. Informal definition: the costs of doing business. The stuff we used and had to pay for or charge to run our business. Additional explanation: some examples of business expenses are office supplies, salaries and wages, advertising, building rental, and utilities. Hopefully a business earns a profit called net income. Revenues are larger than expenses. If, however, expenses are larger than revenues, a net loss results. The major sections of an income statement are the heading, the revenue section, the expense section, and the final calculation of a profit or loss. The heading should contain the name of the company, the title of the statement, and the period covered by the statement. A single-step income statement is the income statement format where all the revenues and gains are grouped together and totaled and all the expenses are grouped together and totaled. Net income is then calculated by subtracting the total expenses from the total revenues. Businesses that are retailers, wholesalers, or manufacturers that sell products have a special section included in their income statement called cost of goods sold. This section computes the cost of the goods sold that were either purchased and sold or manufactured and sold. In retailing and wholesaling, computing the cost of goods sold during the accounting period involves beginning and ending inventories. In manufacturing, it involves finished goods inventories, raw materials inventories, and goods in process inventories. The multiple-step profit and loss statement segregates the operating revenues and operating expenses from the non-operating revenues, non-operating expenses, gains, and losses. The multiple-step income statement also shows the gross profit, net sales minus the cost of goods sold. The capital statement. The capital statement serves as the bridge between the income statement and balance sheet. It uses the net income, loss from the income statement in addition to the owner's investments and withdrawal to determine the owner's ending capital balance shown on the balance sheet. Balance sheet. A balance sheet is simply a picture of a business at a specific point in time, usually the end of the month or year. By analyzing and reviewing this financial statement, the current financial health of a business can be determined. The balance sheet is derived from our accounting equation and is a formal representation of our equation assets equals liabilities plus owner's equity. If you recall, in an earlier lesson we learned that this equation is also called the balance sheet equation. The categories and format of the balance sheet are based on what are called Generally Accepted Accounting Principles (GAAP). These principles are the rules established so that every business prepares their financial statements the same way. What makes up a balance sheet? Assets. Formal definition: the properties used in the operation or investment activities of a business. Informal definition: all the good stuff a business has, anything with value. The goodies. Assets. Additional explanation: the good stuff includes tangible and intangible stuff. Tangible stuff you can physically see and touch, such as vehicles, equipment, and buildings. Intangible stuff is like pieces of paper, sales invoices representing loans to your customers where they promise to pay you later for your services or product. Assets. Examples of assets that many individuals have are cars, houses, boats, furniture, TVs, and appliances. Some examples of business-type assets are cash, accounts receivable, notes receivable, inventory, land, and equipment. Assets are listed based on how quickly they can be converted into cash, which is called liquidity. In other words, they're ranked. The asset most easily converted into cash is listed first, followed by the next easiest, and so on. Of course, since cash is already cash, it's the first asset listed. Liabilities. Formal definition: claims by creditors to the property, assets of a business until they are paid. Informal definition: others' claims to the business's stuff. Amounts the business owes to others. Liabilities. Additional explanation: usually one of a business's biggest liabilities, hopefully they are not past due, is to suppliers where they have bought goods and services and charged them. This is similar to us going out and buying a TV and charging it on our credit card. Our credit card bill is a liability. Another good personal example is a home mortgage. Very few people actually own their own home. The bank has a claim against the home which is called a mortgage. This mortgage is another example of a personal liability. Liabilities. Some examples of business liabilities are accounts payable, notes payable, and mortgages payable. Liabilities. Liabilities are listed in the order of how soon they have to be paid. In other words, the liabilities that need to be paid first are also listed first. Owner's equity, capital. Formal definition: the owner's rights to the property, assets of the business, also called proprietorship and net worth. Informal definition: what the business owes the owner. The good stuff left for the owner assuming all liabilities, amounts owed, have been paid. Owner's equity. Additional explanation: owner's equity represents the owner's claim to the good stuff, assets. Most people are familiar with the term equity because it is so often used with lenders wanting to loan individuals money based on their home equity. Home equity can be thought of as the amount of money an owner would receive if he/she sold their house and paid off any mortgage loan on the property. Owner's equity, or net worth or capital, is increased by money or property contributed and any profits earned, and decreased by owner withdrawals and losses. All balance sheets contain the same categories of assets, liabilities, and owner's equity. The major categories are presented side by side using the account form layout. Another layout sometimes used is called the report form. In this form, the major categories are stacked on top of each other. The balance sheets I presented for our mowing guys is a simple representation of a balance sheet. Normally, a business prepares what is called a classified balance sheet with many categories. What's the difference? Special categories are included, namely, current assets, fixed assets, current liabilities, and long-term liabilities. Cash flow statement. The last financial statement, the cash flow statement, is prepared to report all the changes in cash that occurred over a period of time, usually a month or year. The major sections of the statement are the heading, a section for reporting the increases in cash resources provided by, a section for reporting the decreases in cash resources applied to, and a summary of the change in cash increase, decrease for the period. If the business was in operation in the previous year, the prior year balance sheet along with the current year balance sheet and current year income statement is needed in order to prepare the statement. Additional analysis of some of the accounts may also be needed. Summary of how to prepare the statement. The first step is determining the cash provided or used by operations and begins with the operating income for the period. Adjustments are made to the income for revenue or expenses items that did not provide or use cash. Additional adjustments are made for all current and non-current accounts and are recorded as addition or subtractions depending upon their effect on cash based on their beginning of the year and end of the year balances. Notes to financial statements. Notes to the financial statements are an integral part of the statements and are required by generally accepted accounting principles. Notes to financial statements, sometimes referred to as footnotes, are used to provide additional information about a business's financial condition and methods used at arriving at the amounts presented in the financial statements. These notes contain important information about such things as the accounting methods used for recording and reporting transactions, any pending lawsuits or regulations that may affect the business, and other information that should be disclosed in order to properly analyze and evaluate the financial condition of the business. The good news. While these financial statements were prepared from just a very few transactions, my goal was to introduce you to what formal financial statements are needed and what's involved in preparing them, even though the bookkeeper may or may not be required or responsible for preparing them. Many businesses have their accountant or CPA, certified public accountant, prepare or review their financial statements. Another plus, nowadays, good accounting or bookkeeping software will automatically generate these statements. While this is great, we still need to be aware of that old saying, GIGO, garbage in, garbage out. Are we there yet? Analyzing financial performance. While preparing financial statements is critical to the success of a business, it's only half the battle. In order for a business to fully benefit, the financial information needs to be analyzed and compared. A few tools used are comparing past performance with current performance and comparing how the business stacks up against its competitors or similar businesses. While the financial statements presented in the lessons are simplified versions of the real world and were compiled from only a few financial transactions, the concepts and methods used are the same as you would use for a business with a multitude of transactions. So things do change. The Financial Accounting Standards Board (FASB) and the International Accounting Standards Board (IASB) are continually working on projects and changes to the financial statement presentations, as well as the accounting rules may result. Special thanks to Ron Leishman for the cartoons. http://www.tunaday.com